Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Phil Mackintosh, chief economist at Nasdaq, for an update on the latest COVID-19 news, the U.S. and global economies, and how investors are reacting as we make our way back to a new normal. And Phil, the question is, can the U.S. successfully reopen its economy with COVID-19 cases hitting record numbers? And the shame of it is, and we could see this on our first couple of slides, economic data was slowly starting to improve, but that could be in jeopardy if we continue to hit new record cases every day.
Yeah, so let's talk first about the economic data, because it's sort of telling us now why the market's been rallying so much the last few weeks. If you look at the economic surprise data, that's really strongly positive. And it's not that the data itself is positive, it's just that the data is coming in a lot less bad than analysts had been expecting. From the unemployment rate starting to fall already, to some of the rebounds in retail spending. And today we're looking at the manufacturing PMIs. So the manufacturing PMI, manufacturing itself looks like it's been pretty slow to rebound. But the fact that the PMI, which includes a lot of expectations from manufacturers, has come all the way back to 50 so quickly is a positive. So 50 itself is neutral. So what we're seeing here really isn't a V-shaped recovery, but we're seeing the fact that everybody shut down their factories happened a month or two ago, and now everybody's looking and going, I'm not shutting down anything more. I'm actually kind of neutral about whether things are going to get better or worse. But that itself is a pretty decent recovery in attitudes and expectations. So we've seen retail spending recover much more quickly than manufacturing, but the fact that manufacturers aren't totally nervous is a good thing. If we start to talk, though, about the data, I mean, that's really the reason the market is down this week is because of the new cases, which you sort of referred to as well. And overnight, it's been reported that America has just topped its old record for new daily cases. It looks a bit like America is having a second wave of cases, but actually it's not. If you look at the data, the first hump there was all of the New England cases, like the Northeast and Seattle, having their wave of cases. What's happening now, and we've been talking about this for a week or so, is just the increase in cases now in the southern states. And so when you look at those states, they've obviously been slower to see COVID start to appear, but now that it's there, and now that it's sort of getting broadly enough spread that the R number, the contagion number is spreading to lots more people every single day, you can see that their caseloads are picking up and accelerating. There's already been reports about hospitals being stressed and having to turn over some of the old wards and beds to ICU for COVID patients. And I think one of the telling signs, if you look at the map of who's wearing masks, is those states that had COVID early, that have tackled COVID pretty well, are almost all now making mask wearing mandatory. As the weather heats up, it sounds like some people are going indoors because of the air conditioning, and obviously the spread of COVID, we know it's pretty contagious, and it's clearly starting to spread across a lot of those states. And so the real risk is, if it's spreading in those states this badly, will they now react just like the Northeast reacted by shutting down businesses and shutting down restaurants and forcing another wave of stay at home? Maybe for half of America, but we saw already what an impact that had on unemployment, what an impact that had on the economy and production and retail spending.
Phil, you know, it's interesting. I haven't heard many people talking about the Fed's balance sheet, because that really has been a big part of the news cycle as well, with the stimulus being injected into the system and what that's done to help propel the market as well. But it looks to seem, that they're tightening it up a bit on the balance sheet.
Yeah, it's interesting because obviously back in March and April, a lot of the reasons the market didn't fall as much as it did, or for the strong bounce back days, was because the Fed came straight in with hundreds of billions of dollars of stimulus, sometimes trillions of dollars of announced programs. And the balance sheet started to expand, and they were actively buying a whole lot of different bonds in the market and opening up new programs. Since then, obviously, things have started to recover. And so you can kind of see that in the data. The drawdowns, or the additions to the Fed's balance sheet started to fall in April. And we saw that the last week it actually saw a reduction in their balance sheet. And when you look at the data, a lot of that is just because some of the old repo programs, which really had nothing to do with COVID, but were happening before that, are now starting to reduce. So it's good for the Fed, I guess, in terms of its balance sheet not getting too bloated, because we have plenty of debt being added to the system right now for future generations. But it's interesting from the perspective of normally you don't want to fight the Fed. Normally when the Fed is injecting money into the system, the market goes up. And right now it looks like the Fed's kind of gone back to a neutralish stance, at least in terms of how their balance sheet looks.
And how about the impact on inflation?
Yeah, I mean, that's the real problem longer term with all these stimulus monies. It's definitely added a lot of money to the system, so to speak. And when you look historically at growth in money, that's typically associated with periods of strong inflation. And it makes total sense. If there's more money in the system with the same amount of goods, then the only way to allocate that money across the goods is for the prices to go up. It's kind of economics 101. So the risk right now is we've injected a whole lot more money into the system. It's just not moving around as quickly because people aren't spending as much. But if we start to see an increase in demand, then the Fed's going to have to work out how they manage this, whether they can reduce the money supply as the demand goes up, or whether we're going to run the risk of a new period of inflation. And I think that's another thing that's supporting the stock market. Obviously, when you're owning bonds, you're only ever going to get back par. So you're a little bit hamstrung when inflation starts to kick in. The money that you're going to get back from your bond is actually worth less in real terms. But companies are a little bit better positioned, maybe not in the short term when rates go up to account for the higher inflation, but over the long term, companies can increase their prices, keep their margins constant, and their stock prices will go up because of that as well, and so keep track with inflation. So there's a lot of different things going on, and inflation is probably not a discussion to have until we have a vaccine or a cure for coronavirus. But it is something that we need to have in the back of our minds. It's probably driving some of the market performance, and it's definitely going to be an issue to deal with over the next 10 years.
All right, Phil, great stuff as always. Thanks so much for joining me on Trade Talk.
Thanks, Jill.
All right, thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.